Hello and welcome to another review of where things are in the financial markets. Right now, the defining characteristic seems to be uncertainty, but in an odd way. Right now, it seems like market participants aren't quite sure what they should be doing. Geopolitical fears is certainly a big one, but at the same time, the big outstanding question of the American domestic situation, whether the new nexus of Trump, Besant, and the Warsh Fed are going to successfully assert themselves over the American economy. Global capital doesn't quite know where to go. It doesn't really know what's going to be safe in the long run. But at the same time, right now I'm seeing so many people who seem extremely confident in what's going to happen, at least in their own little corners of the market. And part of that is just the media environment right now. Everyone wants to put out a podcast that says something like, Bitcoin to $500,000. Or maybe gold is going to double by next year, or silver's going back down to 50. We're just in an environment full of extremely high conviction theses, at least that are put out for the public. And not to put them down, there are some very brilliant investment minds out there being quite open with the public, and their trading seems to match what they're saying. But as always, be extremely cautious with financial media. And there are some signs. There are reasons for people to be confident about certain bets. I'm certainly not averse to high conviction bets right now, but it's just curious how many people are either really high conviction or just on autopilot in an international market defined by uncertainty. So taking a look at equity first, these aren't massive changes here. I still feel much more comfortable with American domestic equities, but I'm not ultra high conviction anywhere, at least in the short to medium term. Maybe medium to long term, do think that we will see international capital flowing to the United States. But short run, things can pop up very suddenly, and with issues like credit market strain, or the possibility that something destroys the bullish narratives, I can't quite bring myself to all in full steam ahead. In this economic pivot, with new economic policy, onshoring, industrialization, and the beginning of international capital flowing to the United States, I am inclined to small cap and value, as it seems to me like things like those long neglected industrials, hard asset businesses, or other core fundamental economy companies that are trading at good values in the small cap, that haven't had eyes on them in quite some time, are where pretty good opportunities are. And also a place that I just feel better hanging out in a sea of really high multiples. Emerging markets is really wild and volatile. And I think emerging markets has to be played on a country-by-country level, or at least regionally. I don't have any broad EM exposure through anything like index funds. I do have a fair amount of emerging market stocks, but all of them are individual stock picks. And that for me in my portfolio has been overweight. Developed markets, there just aren't that many that are that great. Canadian resources maybe, but some of the domestic problems in Canada do create some new risks. I have opened up some Mediterranean, including Greece and Turkey, and a bit of Eastern Europe. And I'll be writing more on the Turkish banking sector later in the report, on the essays. Really, the core driving this is that there are a lot of neglected areas that are starting to see signs that capital is finding them. As capital rotates around the world, as natural resource flows are rerouted, and as business dominance remains with AI, I'm generally inclined to looking in Asia, Latin America, and some of Eastern Europe and the Mediterranean. Real assets are little changed. The big difference is that I'm less underweight on oil than I was earlier. In the last report, that was after oil prices had spiked up wildly, and so I was very bearish on them at that point. There may still be some room for oil to settle, and based on new commodity flow paths, we very likely could see a future environment with lower gas and oil prices and lower volatility, particularly as we add new energy technologies like nuclear and if we improve extraction technology. I'd also consider Venezuela expanding their productive capacity to be a factor in that. But right now, based on the dynamics of what producers need and what strains still exist, it's going to be very hard to get crude much below 70. And so at time of recording, as oil prices in the futures are hanging out in the low 80s, there could very well be opportunities in oil producers. And certainly for me, I believe that there are with refiners. And particularly if the destruction of refiners continues in California. Commodity producers are realizing that they need to update the robustness of their supply chains and production. There will be opportunity in there. But across the board, if one's thinking about oil in aggregate, the commodity, exploration, refining, marketing, production, it's unlikely that there is much more price downside in oil itself. And so if we see it hanging around 80, that's probably pretty reasonable. Gold and precious are very interesting. For the last several months, my main exposure has been through miners. My position has been certainly much smaller than it was at the end of last year and the beginning of this year, though I remained a positive position. And that all said, I'm still long run quite bullish toward gold and to a lesser extent silver, though if there were another very large bull run, silver does stand a good chance of outperforming. While industrials have been a bit more resilient, and I've been leaning toward more copper than silver. Last quarter, it appeared that there was opportunity to me in gold and precious metals, but my main concern was some sort of dollar liquidity squeeze, which happened. And that could certainly happen again. Also, it doesn't appear as though that Chinese gold buying is still going on, or about to pick back up. But that all said, I've begun nibbling back into gold at a much faster pace, and I've as well been using options to do so in part. So I'm certainly not calling for an immediate gold or precious metal bull run, but I do believe that there's opportunity there. I also believe that dollar liquidity squeeze remains the biggest risk, but at least for my own part, I am nibbling. No real changes to debt this month. Right now I'm still leaning toward short duration. There aren't many foreign sovereigns that I would want to touch at all. However, and as I'll discuss later in the report, markets do seem to misunderstand the character of the new Fed Chair Warsh. So there certainly could be opportunities in playing the curve. And I have ticked up short duration as well. But I'm still not quite in a spot where I would want to add much to long duration. So it's pretty well unchanged. But instead of being all concentrated in that cash corner, the shorter end of the US yield curve could have some good opportunities, particularly if the market is expecting rate hikes in a way that they probably shouldn't. I'm adding a new part to this tilt section, factors. Now this isn't any specific factor model, but it's pretty close to the Fama French and a little bit of the changes proposed by AQR. There isn't anything that I'm ultra bullish on here, but am cautiously tilting toward beta, as talked about earlier, cautiously tilting toward small cap, and tilting toward value. I am taking business quality as much more important right now, particularly as we are seeing some frothiness. Now, noting frothiness doesn't mean that I'm saying that there will be a narrative pop or some sort of big collapse of a bull run, but when you do see very high valuations and stories start to price in flawless execution, when you're looking around at companies, it can be a lot more important to make sure what you're buying has a very robust and reliable business behind it. Carry is just something I really wouldn't seek all that much right now. There are certainly some yields that one could pull off some assets, but there just doesn't seem to be that much compensation right now. And the risks of carry decomposition, or particularly unseen negative carry creeping in and eating, just make it so it's a factor that I'm really not trying to lean toward. I've built out the regional allocation table. The main change is being a little bit more confident United States in relative terms. Really, for the whole run of these reports, I've been much more confident United States. I have that overweight to Eastern Europe that I noted earlier, and I'll have more coming out about these regions later that can go further into depth. But largely, these are neglected places with good fundamentals, and some of them seem to be positioning quite well for the geopolitical changes that are unfolding. It's much more of a macro thesis. Middle East is still underweight, and that's just because really it's an oil play largely. There's still a lot of geopolitical uncertainties out there, And even if I am personally more optimistic on the Iran war, that doesn't mean that there aren't risks that could pop up and really thwack a portfolio. And on top of that, there just aren't that many opportunities that I can see. The main place, particularly if you're trading on US markets, are Emirati stocks. And I looked through all of the ADRs trading on US markets. I'm not saying that there's nothing good, but nothing really got my attention. Japan is as well overweight, and this I was very bullish on earlier. I still remain bullish, but it's quite possible and even quite probable that things do settle down a little bit after a particularly strong bull run, and if we see any friction from rate hikes in the short run, it would certainly make sense to me if we saw a slowing down in Japanese equities. But long run, this all still looks very good to me, and so I'm keeping a quite reasonable allocation to Japan, even if I'm not adding to it the way I was earlier in the year. There are some other opportunities in the Pacific that I've been looking at. I've been holding a Taiwan exposure for a little while. After Korea got hammered, there very likely could be some cheap opportunities there. I haven't really looked through that, so I can't say for certain if there's something that I believe is a good play that I might do, but I figure it might be worth looking at. And really, this is another macro geo outlook. For the past several centuries, the Atlantic has been the heart of the action for pretty much everything globally. That's where the important shipping was, and that was the connection between the United States and Europe. The Atlantic is still very important, but the Pacific is becoming more important faster. Going forward, the connection points between the United States and Asia, particularly the giants of the United States and China, the United States and Russia, and what we see emerging as some of the new strategies between the United States and Japan. Man, real estate is really boring right now. I mean on the table. Pretty much everything I have around some sort of neutral. Industrial and warehouse I still have more positive sentiment towards, but particularly in the data center space, we have almost certainly seen far too much over-allocation, and we are starting to see some problems creep in. I very much believe that there is still a lot of opportunity in industrial, storage, and warehouse that are going to play out in the medium to long run. It still seems to me like this is a fundamentally good spot, but particularly owing to some private real estate funds, and particularly in those data centers, there's just a lot that now doesn't quite seem like the time in the short to medium run. I would think that there are probably some very good opportunities in that space, but would be very weary at this point as an overall category, as the sheer frenzy of institutional investment was just wild, and particularly if we do start to see state-level regulatory hurdles increase. Leisure I'm still a little bit weary of. I keep seeing fund managers who seem to have some really strong, positive, optimistic ideas in the leisure sector, but I'm still, one, not entirely confident on the consumer, and two, behaviors are changing. The big adventurer, traveler, resort goers were millennials. However, even they spent quite a lot of their time in places like Airbnbs, hostels. And now millennials are getting older. There's a very good chance that you might see some strong performance on the sorts of places that retired baby boomers might go to on vacation. I would think that that's probably one of your best bets. But Generation Z are different behaviorally from millennials. Millennials aren't really that reliable, and even they're starting to slow down. And Generation X may be a little too cynical. So do I think there are opportunities in leisure? Yes. But overall, I'm just a little too wary to have any strong conviction. So that's one that I put a little bit on the underweight end. Largely everything else is rather neutral. I'm just waiting to see a sign of something in medical. That always seems like it should move, but doesn't. One thing I will note, while there was the bull story of places like the Sun Belt, Texas, Florida, for years, then the smart money started to realize that there was overbuilding. Some started to look around, and some of the clever ones realized that places like San Francisco might get a rebuild. But largely, the big driving internal migration bull story was beginning to slow down. One thing I will note as an idea to put out there is that we now might be at a point where some of those places have settled to pretty good prices but there are some opportunities. I was listening to a fund manager recently who was presenting a thesis on starting to buy back into Austin. I really can't put my name to that thesis right now, but it does seem like there might be something there. Some of those places that were overbuilt might be starting to see opportunities again. And last, let's look at hedge strategies. Buy right is okay. I have been selling more puts on my cash. I'm particularly using that to nibble back into some metals. In some of the more volatile tech and biotech pharma, I have been selling calls there. But right now there doesn't seem to be that confluence of high volatility paying good premia and the right underlyings to get it done. I still use the strategy, but mostly it's being used as a way to get out of some of my more volatile positions. For me it's just, it's okay. Market neutral, I'm neutral, though with a little bit of overweight sentiment. Just in light of the uncertainty and volatility, I do think that right now is a very good time if somebody is good at identifying idiosyncratic risk and opportunities. A market neutral strategy could play a very valuable role in a portfolio. I'm not really going out of my way to say avoid beta and go all idiosyncratic. I'm not at the point where I'm saying to trim down hard on beta. But I have a generally modestly positive sentiment toward it right now. It's worth considering if one might want to tilt, at least a little bit, more toward idiosyncratic. Short, I still have underweight, and the reason for that is 1, not taking a bearish position on beta in any strong sense, more just pointing out some points of caution. But the larger thing is that it's just a really difficult strategy to get done effectively. Short doesn't really work very well. Today you're either a kind of slimy scammer, someone who points out exaggerated or fake stories, or maybe starts a frivolous lawsuit to go short. Or you're Jim Chanos and you're a very old man. The real successful shorts are well retired by now. This just isn't a good environment. And I keep hearing people who have theories on how to get it done, what the way to use it is. And I certainly see a role of short. Spread trades and arbitrage could be very worthwhile right now. But a real dedicated short fund? There just doesn't seem to be that much juice in it. I'm still quite confident managed futures, and I think that there is some real opportunity in metals. Copper has been relatively having some pretty good strength, and though gold and silver have been getting beaten up, managed future trend following has done very well. And if there is a reversal that appears soon, if someone can hit that properly, that could be a very lucrative trade. What I've been doing in things like gold, silver, and even Bitcoin is I've been taking hedge-based positions in the asset while I slowly nibble by selling options. I'm not ultra bullish on managed futures, but it still seems like now is a relatively good time for a good manager. And I very much believe in this time of geopolitical changes and very hard and sudden trends, there's a real place for it in the portfolio. There could be something in event-driven, but I don't really see much for it right now. There have been some event-driven managers who have been doing very well in recent months, but as an overall strategy, now just isn't quite the environment where it thrives. I'm not hugely bullish on distressed right now, but I can imagine a few scenarios that might be fast approaching where it could do very well. So I'd very much keep an eye on distressed. Although at the moment, I'm not going into it. And by far, the one that I'm the most pessimistic toward is one that I've discussed before. Carry trade strategies. I just do not feel good about carry trades right now, and particularly the yen trade. Global macro is still looking very strong to me. And the reason for that is just that we are in a place where global, geopolitical, geoeconomic, big global geo events are driving. It seems to me like a really good global macro manager is probably in one of the best positions possible right now. And global macro is interesting because very often it doesn't get huge returns. It just sort of goes along. Usually it doesn't have any really bad performance, but usually it's not really spectacular returns. But when there is a big global pivot point, that's when it really shines. And you see these very high returning years that end up with a total average performance over the long run that's spectacular. To me, I am still very much feeling, and probably for the next few years, that this is the time for global macro to shine. Alright, let's move on to some of the opportunities, and then I'll have essays as well, which will come out separately on Substack and as videos. So first, I want to elaborate further on small cap. The small cap space in the United States has been in a tough lagging spot for the past decade, bringing much frustration to the followers of traditional factor models. The classic idea of the small cap premium should not be written off as a relic of a bygone age, however. Perhaps the premium still stands, but with a new character. Small caps have been disadvantaged by passive flows and more restrictiveness on the part of manager mandates, yet substantial shifts in M&A activity keeping top companies private longer, IPOing companies at higher market caps later in their life cycles, and the presence of so many low-quality companies in major small-cap indices, disadvantaged in the post-GFC ultra-low rate and regulatory environment geared toward large firm capitalism, have all conspired to a tough slog for small-cap. The macro environment is changing, however, and in the new tariff environment where regulations and credit facilities are being shifted toward smaller domestic firms and domestic labor, small cap has been put at the heart of a fundamental bet. Will this new economic model be successfully implemented? Beyond the more direct efficacy question, the big hinge point that seems to be what will open the floodgates to small cap outperformance appears to be a question for international capital. Fundamentally, if international allocators believe that the new economic regime and its agents will successfully entrench in the United States, then capital will seek American small cap. The rerouting of global energy flows away from the classic choke points, the removal of the unrestricted carte blanche of international credit creation, the decline of dominance of international institutions, and the inability for international actors to retain influence over American firms are all emblematic of the same bet appearing over and over as a fractal throughout all of international capital. If one believes that Warsh and the non-Keynesians will reign at the Fed, if one believes that the Besant Treasury and novel government credit facilities will pull fiscal dominance back toward national credit and regional banking, and if one believes that reshoring, deregulation, and the return to a hard asset base will prevail, then as international capital allocators come to see that American small cap will have not only structural disadvantages removed, allowing their expected return premium to return, but capital should flood in from abroad, giving higher returns to small cap companies of quality and placed in the leading sectors. Credit remains precarious as it has for some time. A major problem with hedging out global credit risk is the brutal bleed from carry associated with most approaches. BDCs represent a very strong proxy for private credit, while British and European banks represent highly sensitive proxies to both European sovereign debt and Eurodollar credit creation. The main trouble with a derivative bet on BDCs is the illiquidity of their markets. There are some exceptions, but finding options on BDCs will be much more sparse than most sectors. Bets against Eurodollar banks is much more straightforward, with some highly liquid options markets. However, it should be considered that while the reasons they might drop are strong and evident, there are as well many reasons why they might push higher, particularly the risk of European equities rising if investors flee credit markets. I have, however, been taking a tactical approach, utilizing options buying OTM leaps on BDCs, while identifying key Eurodollar banks and their particular balance sheet sensitivities to enter positions into should the proper environment arise. These could serve as valuable options to consider for a portfolio if one has credit concerns, as I have articulated in the past year. Another approach which comes with its own set of nuances is steepener and flattener trades, or a complex options approach, utilizing out-of-the-money puts on corporate bond ETFs, like HYG or LQD, depending on whether the point of focus is credit duration itself, and VIX calls. There are many avenues which can be used on their own or in combination to address the emerging risks within credit. I have been utilizing the BDC approach thus far and have been analyzing Eurodollar bank possibilities. Each portfolio should address its own distinct set of risks when it comes to structuring this form of hedge, but this certainly has been something which I have been giving heightened attention to, and in some circumstances could be enormously worthwhile. Alright, so let's take a look at the incoming Fed chair. The conclusion I've reached is that he is a much more radical departure from the Fed chairs of old than seemingly any of the market realizes by this point. Markets seem not to have any good sense of how to think of the new Fed chair, Kevin Warsh. Many have looked at his past statements, read his work, and watched his interviews and concluded that he will be some departure from the chairs of old. But few seem to be able to give a clear explanation of what this will in practice mean. If one believes that he is opposed to the Greenspanian model of jumping into the market's rescue or Powell's hand-holding, then one might be inclined to imagine a hawkish Fed, one using monetary mechanisms to constrain the supply of money and credit. The market clearly seemed to get spooked when Warsh declared that he would no longer be hand-holding and signaling the Fed's every next move. When a reporter asked what market participants could possibly do without the Fed's constant granular guidance, Warsh answered simply that they should look at the real economy and trade accordingly. If one, however, imagines that Warsh will be tightly aligned with the Trump White House, then he might think that he will be a dove, bringing rates down and money ample to liquefy the reshoring Trump industrial economy. Both of these, I believe, miss the point of what Warsh is affecting. Warsh is neither a hawk nor a dove, as he is outside the Keynesian monetarist philosophical operating system that has been taken as a given by the Fed for generations. Warsh has stated that he rejects the Phillips curve and the very notion that wage and output growth should be treated as dangerous inflation to be stifled with monetary action. He appears to reject this entirely, and so I believe it would be a mistake for one to look to traditional indicators to gauge whether he will move for monetary actions. His philosophy appears to be one which does not believe in Keynesian contracyclicality, in the Fed's role being to hold its dual mandate and treat technical inflation from growth as equivalent to monetary expansion, nor to hold the market's hands to safeguard capital. Warsh appears willing to align himself with the Besant Treasury, which is pulling national capital back toward Treasury dominance and domestic bank credit, and that could very well mean a Fed that is much more willing to stand back, defend the dollar from actors abroad, and place the growth of the real economy ahead of traditional markets and metrics. If one is able to break through the Keynesian assumptions most of us were educated into and imagine a world where the Fed is simply a facilitator of national capital and economic growth, no longer trying to engineer away booms and busts, then one may very well be able to anticipate the actions of the Warsh Fed at a level far beyond where markets seem able at present. The last idea I want to talk about is admittedly not completely formed yet. I'm not fully certain, and I haven't done enough research to my satisfaction. But that said, I did want to include it in this one because I believe there really could be something here. Turkey is very curious. In recent years, the country has seen year-over-year official CPI inflation rates of around 72%, 53%, 59%, and 35%. The country has been in a very difficult bind, inflation running very high, while Islamic cultural assumptions have made sharp rate hikes much more uneasy a solution than one might leap to in the Keynesian neoliberal West. In order to adapt, some of Turkey's major banks have taken large positions in floating credit and inflation-linked securities. In US OTC markets, Akbank, one of Turkey's largest banks, has risen about 129% over the past 5 years, while another giant, Turkey Garanti, has risen around 168%. Akbank is backed by the industrial conglomerate Sobanski Holding, while Turkey Garanti is in large part owned by the Spanish Latin giant BBVA, which has given the Turkish bank preferential access to credit markets. In large part, analysts have looked to Turkish inflation and economic recovery in order to gauge whether these banks may be worth investing in. Yet Turkey has another significant nuance that may be an equal or even greater factor in coming months and years. Turkey is geostrategically important, and very much so. Not only does the country hold the dominant position over the Bosporus and thereby Black Sea lanes, but it remains the gateway to the Middle East, as it has since the ancient world. Turkish President Recep Erdogan has been in a tricky spot, attempting to play multiple sides at once to get him in the best position possible. Yet while he has remained an unreliable actor, he has never been able to secure reliable support. The Trump administration appears to be angling to bring Erdogan's Turkey into the American strategic vision and sphere. If this is the case, then the United States will most likely extend to them an economic incentive, something which places them on stronger footing with respect to international capital. The most straightforward and likely effective way to go about getting Erdogan on side, with Turkey in a strong position in the sphere, and ensure the country is retained in America's strategic vision, will require them to be stabilized and thus subject to a reliable, friendly United States, with their banking system at the heart of American capital flow stabilization. This would disproportionately benefit the Turkish banking sector, and these large international Turkish banks. I've been looking at AKBTY and TKGBY, trading on American over-the-counter markets, as vehicles to express this asymmetry potentially. While it remains uncertain how the American relationship with Turkey will play out, there are indications of Erdogan shifting to American alignment, at least with respect to the strategic vision. And as there is such asymmetry in this scenario, I have considered the probability upside potential to be very worth looking at closely. The upside scenario would likely follow this general pattern. Erdogan assents to the American vision, the Trump administration and financial allies, in part via international agreements, enter into a capital stabilization program. And finally, Turkish banks who have been operating very cleverly in this difficult environment experience explosive upside, coming from very attractive, cheap valuations in bad times. There are certainly scenarios where this US-Turkey agreement does not unfold, but the unique asymmetry and reasonable probability of this potentiality places Turkish bank stocks among the ranks of those special global macro bets that only come along every so often, and should be looked at very closely when they do. Alright, that's all on the core report itself. I'll have the more in-depth essays going out later, and they'll be on Substack, and there will be recordings that go on YouTube as videos as well. A few more documentary series are about coming out. Both the monetary series and the liberalism series are about reaching their final episodes. There's going to be a film on In-Q-Tel and the realm of defense, intelligence, private secret capital, and then another one in the series of the global order changes, this one focusing on Western Europe and Britain. And that one's a much slower series to get out, but is still certainly coming along. So if you want to check out more of those, then certainly subscribe and check out things on Substack. Keep following along. Enjoy the night.